Hey guys, Ryan Dement from Chasing Financial Freedom podcast. Hope you guys are having a great day. Today on the podcast, we have Steve Sellengut, and I actually got that right. He's the income independence coach. And I think we're going to have some great conversations around money, but also I think there's going to be some valuable conversations to be had because we're on two opposite sides of the spectrum in baseball. I'm a Red Sox fan. He's a Yankees fan. Steve, welcome to the show.
Well, thank you, Ryan. Good to be with you.
You're more than welcome. So before we get into what you're doing, can you give the listeners some background on who you are?
Okay. Background is I'm a semi-retired professional investment manager. I started doing that kind of work back in 1979, believe it or not, when I was just into my 30s. During that period, I managed up to $110 million for 135 different client families, mostly in the United States, but some overseas. My focus was quite a bit different from the normal investment management approach. My approach was to build a client's income production and reinvest the majority of it so that it would continue to grow and to grow that income to the point where when they retired, it was making a whole lot more than what they needed to run their normal day to day lives. Now, of course, as you said, I call myself a retirement income independence coach because now I'm mentoring people who have read my book and who want to overcome that barrier that they have, that they constantly have to sell securities to take that vacation or to help their kids go to school or grandkids go to school and stuff like that. My approach generates income, doesn't chase the market value around. And consequently, it doesn't really matter to me or to the people I convince to try this approach. It doesn't matter whether the market goes up and down, or it doesn't matter whether interest rates go left or right. The income pretty much stays the same and continues to grow in all circumstances.
So you're specifically working with advisors that are licensed.
I'd like to help them, but they don't seem to want my assistance. I'm mostly working with individuals.
Oh,
Yeah,
okay.
individuals who have read the book, like I said, it's called Retirement Money Secrets, and are curious how they can do what I've done and what my clients have done. Advisors get paid on amount under management, and their bosses don't smile at them unless they continue to grow the amount under management. They don't care about whether all your clients are smiling. They want to smile. So it's a little different.
So where do we start? I guess my question is why this space and why, let's just start from the beginning. You said you started in your 30s. What got you there?
Oh,
What's
I
it
guess
doing?
one of the first lessons you learn is that you have to choose your parents well, and so that you don't come out of college with a lot of debt or anything like that, and you actually get some opportunities early on. Some of those, I guess, almost an aha moment, you'd call it. I was very fortunate when I was 25, having pretty much given my father a large percentage of all the money I made as a kid. Some of it I was working in his lumber yard like that.
Mhm.
So I would give that much money to him and he would invest it. And I guess he was investing it for helping my college or whatever and other things. But when I was 25, I got a big lump of stock certificates dumped on my desk. And he said, "Now it's your responsibility, kiddo." He used to call me that. Yeah. So I had all this paper in front of me and value and stuff I really didn't understand all that. I was a business major, but never really got into discussing the stock market and stuff like that. So I had to learn all that. And I studied it and I studied the charts. I was fortunate in having an agent that didn't try to sell me stuff. Oh, sell all your stuff and we'll put you in this fund or whatever. Of course, there weren't that many mutual funds back then anyway. But no, we looked at it. We realized they all all those stocks paid dividends. They were all well respected, S&P rated B plus and better, and they all had very similar patterns up and down. If you went back 20 years and you saw the same up and down patterns, higher lows and higher highs, of course, but the patterns were the same. And you looked at it, you said, geez, if I can buy something when it's down in this pattern and I can sell it when it goes up 10% and keep doing that because if you looked at 100 different securities, they all pretty much had that same pattern, the high quality dividend payers. So that's what I did. And within 9 years, I was making 4 or 5 times more from my investment portfolios, both in the dividends and the profit taking, than my job. And I didn't really like my job. I had to commute to New York. I had to commute to New York every day. I never knew when or if I was going to get home in the winter, at night. I was happy to say at that point, I've got a story here that I can talk to this guy or this guy, people I knew who were successful professionals and stuff like that. I can show them that I can do this for them. I'll I'll start a business doing that, and that's what I did. I left that job and started a business.
So, if we are somebody that's looking to start doing this for ourselves, where do we start?
I guess what anybody who's hearing this should say to themselves is, let me have a look at my portfolio. Geez, I've been hearing about my total return, and some years that's good, and some years it's not so good. And wow, the market's up, and look how much I've grown. And then all of a sudden it's not there anymore because of COVID. Let me look at it closely. Let me see if it generates any income. Now, if you were to do that, you'd probably find that it generates less than 3% income, real income, regardless of what it grows in market value from here to there or whatever. Then the actual income that you could spend if you wanted to is only about, will be that in that at or around that amount. If you have a managed portfolio, you're giving almost half of that to the investment advisor, at least a third of it. And if he's not making any capital gains, you're really running at a 1.5, 1.6 pace after expenses, which isn't going to pay for a whole lot of vacation time when you retire. So you need to build that. You need to talk to the guy and say, hey, there are securities out there that pay a whole lot more income than this model portfolio you have me in right now. Yeah, I've got 1.67 shares of Berkshire Hathaway, and I have 13 shares of NVIDIA and 27 shares of Microsoft. Wow. But they don't pay any income. What am I going to do when I have to say goodbye to my job, my employer, and I want to go see the world? So that's the first step. Take a look at what you've got now and then figure out what you can do to make more income. Now, again, there are securities out there that pay significantly more income than your average mutual fund or ETF while owning the same securities inside the fund as those other entities do. And just as ETFs and mutual funds are a lower risk because they own so many securities inside, that's why they're popular. It's much less risky than going out and trying to figure out which one is going to be the next Google or Microsoft. These funds, these ones that I'm talking about, own those same securities, but they're pass-through trusts. They're trust vehicles like you would set up for your kids in your will and stuff like that. They're pass-through trust, and as a pass-through trust, they are required to give 95% of their income, whatever the source of that income is, be it distributions, dividends, interest, profits, whatever, to their shareholders. So wouldn't that be nice if the FANG stocks all gave 95% of their profits to their shareholder instead of most of it to their senior executives? So that's the type of thing. They're a different type of product. They aren't expected to go up in price. So the AUM cannot be an objective there because look, just like those companies I just mentioned, if they had given away 95% of their income, they would have not grown to where they are today. They reinvest that income. That's their magic. That's how they reproduce. So they're not expected. Their goal is not to grow in market value. Their goal is to continue to produce good income for their shareholders. And so it's a totally different frame of mind. You got to set your mind on, hey, I have to look at how good they're doing at giving me this income instead of whether they're growing their market value. Because most people don't take their profits when the market value goes up anyway. They just sit on it, they love it. On the cover of the book, it says market value fuels the ego, income fuels the yacht. And that's the concept. So that's where I try to get the people who I talk to now. Try to get them to change that mindset, to start looking at growing their income instead of growing their market value. Eventually, if they can reinvest enough of the income and create more capital, their market value is going to go up as well when the entire market goes up or when interest rates go down, one or the other.
So 2 questions. First is, and then I'm gonna circle back to the second is, you didn't talk about taxes. So that's gotta play in a role in some of this.
Okay. So, yes, this is in a personal account. You will pay more taxes. But if let's say you're employed, it's the same principle. If you're employed and your boss comes into your office and he says, hey, we've had a really good year and you played a big part in this. I'm going to give you $100,000 bonus this year. You're not going to say, oh, no, you're not. I don't want that money because I'll have to pay taxes on it. You don't do that. You don't you don't walk by that $100 bill that's lying on the sidewalk and hope that it's more tomorrow. It's the same thing. None of us live in a country where they take as much as 50% of your income. It's less than that. So if you have to, and I say the same thing to people, say, shouldn't we sell things to offset the profits? I said, yeah, you can take $1,000 in losses to save yourself $300. It doesn't make sense to me. It's still a good profit. It's still a stock or a bond fund or something that's paying you 7%, 8%. So that's that. I just said 7 or 8%. And most people are saying, wait a minute, banks don't even pay 5%. There really are at least 7 different types of securities I can name that pay as much as double digits in income. Some are safer than others, but they're out there and you're not going to find them in your average portfolio unless you track them down, unless you discover REITs, unless you discover closed-end funds or business development corporations or master limited partnerships. Did I say REITs? I did.
Yes, you did.
Okay. So that there are those, and then there are even some ETFs that pay high numbers. I call my collections, I call them universes. I have a universe of ETFs that pay between 10 and 11% that I use for some of my wealthier clients because I think ETFs are more risky than closed-end funds and some of the others. So
And what does the typical person, let's say they're starting from scratch, what do they need to start with?
the magic about the closed-end funds that I mentioned is that their prices remain pretty low because they're the ones that are the pass-through trusts. So just as their prices don't go up, even though their yields are high, and particularly when interest rates have just gone up rapidly, their prices go down. So I have literally hundreds of ETFs that are paying on average between 9 and 10% right now. And some of their prices are below $10 a share. So you can go out and for $750, you can buy 100 shares of a fund that's full of all of those equities that you'd like to chase on the NASDAQ exchange or the S&P.
Mhm.
And it owns them in there and it's paying you 9%. So even if you're a very small startup amount, you can do these diversified portfolios. So not be taking an extreme amount of risk. If you're really a newbie investor, I'd suggest you buy income purpose securities rather than equities because they're even less risky, even in these closed-end funds. But yeah, you can start with any small amount of money to to begin your portfolio to do this. Yeah.
Would I guess my next question is because I'm trying to think of the individuals that are out there. So if you're starting from the beginning, you're saying you could start with a small amount. I get that. How do you go about it? Where do you find them? How do you do your due diligence, research, and so forth?
Okay. The research tool that I use for closed-end funds is a website called cefconnect.com. Hmm. And I mention it many times in the book as my source of all the actually of many of the graphics in the book come directly from making up a chart or looking at the past of some of these things in CEF Connect. So there's all kinds of places for that. There's all kinds of books that have been written about closed-end funds. I think mine is the most recent one, but there are others. One's called The Income Factory by a guy named Steve Bavaria. He's more of a traditional investor. He buy and hold and reinvest the dividends automatically. I'm opposed to both buy and hold and reinvesting. I like to make my decisions personally and individually, and I like to take profits as frequently as I can. So I don't buy and hold everything. There's really in the world of income investing, there's two types of income. There's the dividends you receive, and there's the capital gains that you produce from the securities you own. And if you've done enough homework and research to develop a universe of almost 250 securities or more, like I have, then you can easily say, if I sell any one of these, I can replace it immediately or as soon as possible with any others that I've researched just as well. You don't have to reinvent the wheel every time you take a profit. Oh my God, what am I going to invest in? And since you're setting a target profit, a reasonable profit, instead of holding out, oh, I got to make 50% on this or else why bother? That's the speculative nature of how a lot of people approach the stock market. When I was investing just in stocks, I was looking at a 10% profit as plenty because I knew of all these other B plus or better rated companies that I could buy. And now I have the same number of closed end funds that are paying around 10% that I can buy if I take as little as a 5% profit in them. And that's what my target is in those. So I
Is that
trade,
10 is
go
that
ahead.
10% annually?
The profit is today right in your hands. That's when you sell it today. The yield, 10% is an annual yield. Yeah,
Okay.
the annual yield of one of these things is around 10% right now. They range from 6% to above 12%, obviously, is pretty average. And just like anything else, the higher yield, the more likely it is to be a little bit more risky, even if it's in bonds. There are global bond closed-end funds that are probably paying 15% right now. But most of that's because of that in the history in the history of the financial world, I don't think you'll find any other except maybe back in the 80s when interest rates back went up above 12%,
Mhm.
that you won't find any other period since then where interest rates went up 5 percentage points from almost zero to where they are now in such a short period of time. And that knocks in with interest rate sensitive securities, that knocks the prices down pretty steeply, which is why the yields are as high as they are right now. The average yield typically is between 6% and 9%, I think, something like that.
So if I have 0 experience in doing this, where would I start? Read your book? And I'm not trying to
Absolutely.
pitch your book, but I'm just saying
Well,
it's a great it's a tool, so I wanna make sure we
yeah,
mention.
it's just like a tool. I would also read, if you haven't ever been anywhere near the financial markets, you should be reading a couple basic books like what's a stock? You
Mhm.
need to know what a stock is. When you buy 100 shares of a company, what does that actually mean? All right, most people don't know that it's it depends on whether that company even survives. It's if somebody asks you to help him open a pizza parlor and you can have half of the business, you get 50% of the stock in the business. Big deal. He's got to sell a lot of pizzas before you're going to get any money. And he could go out of business just like that. So do stocks, so do companies. Look at Enron, for God's sake, if you remember back to that. But yeah, A lot of people don't know that a stock is literally ownership interest in that company.
Hmm.
And a bond is the debt of that company or of some government somewhere. And debt always gets repaid by a company before the shareholders get repaid. Just those little simple things. You should know that before you ever go out and buy any kind of security. You got to know what you're doing. So I would say a little investments 101. There's got to be an old textbook in the library somewhere that you could read before you do any investing. And then if you're looking for income investing, that's a whole nother category. And you could probably go on Google and get a lot of information on that as well. But then if you want to specialize in securities that pay higher income safely, then you can start looking at the ETFs, the BDCs, the REITs, and the closed-end funds. And I think the closed-end funds is the safest of the three I mentioned. The reason why I don't think REITs and BDCs are as safe is because they're usually single entity type things. So you got one company that's investing in lots of little things in a BDC or a REIT, and also and master limited partnerships, and a couple of them have really strange tax rules, and
Hmm.
you don't get the paperwork until pretty much after you're supposed to be filing your return. So it's very inconvenient for an investor. And you can buy these closed-end funds with all those other things inside them. So you're just dealing with a liquid investment. It's amazing. Like you can buy municipal bonds in the form of a closed-end fund, and you own 3 or 400 different bonds, and you trade it just like a stock. And it pays right now, it's averages about 5.5%, which isn't too shabby for some of your wealthier listeners if they need tax-free income. So
Nice. That's good. The name of your book again?
retirement money secrets.
Is it on Amazon?
Big on Amazon, and it's also out everywhere else too.
Okay.
It's available in all the three normal forms, and an audiobook should be out this month, by the end of the month.
Okay. Are you gonna do, and I asked this because this is how I read. Are you gonna do Whisper Sync to where the audiobook will tie into the digital version?
I don't know what that is. I know I've been asked to provide a PDF because it has a lot of charts inside and graphics, and it's got a glossary of terms of investment terminology that I use in the back. So I put that in a PDF, and I think when somebody buys the audiobook, they get that automatically.
Okay. I will put a link in the show notes to your book so we can make sure that gets out there. And then we're getting close here to wrapping up, but a couple other questions. So one, and I'm back to this because I know the listeners and they're going to be asking some of these crazy things is they know what a stock is. They have a 401k. They have some basic knowledge before jumping into what you're doing. Would you suggest working with somebody like yourself, or what would be some directions that they could do to familiarize
I,
themselves
you
before
know,
they actually jump head first?
I don't know if a coach like myself would be particularly a conversation, a 15-minute conversation for free. Yeah. But a coach for a very small amount of money can be pretty expensive. And
Okay.
I'm not even expensive. 365 an hour for coaching is still up
That
there.
adds up.
It
Yes.
adds up. And really what you want is somebody that can look at what you have to see how much risk you have and to show you how to eliminate some of that risk, to see how your income production is and to show you how to improve it, to look and see if you've got a lot of people hang on to companies and have huge profits in them and never take their profits and hope that's just going to go up until they have to retire or something like that. Things like of that nature. Find somebody to talk about like that. But I think reading the book and just starting doing some research like at CEF Connect,
Mhm.
you can start a nice, safe, diversified portfolio with a small sum of money without paying any extra money for coaching or anything like that.
That's great. And then if they do have a portfolio already, what size would work for you as a coach? What would be beneficial for them?
I've I've coached people with small six-figure portfolios and some with big seven-figure portfolios and double digits there. But you can always start with something like just to get your questions answered. I think when you start investing, particularly with a new product like closed-end funds or even ETFs, you gotta have 100 questions in your mind. And I'll do just pure Q&A with somebody for not that much money, for an hour Q&A, and just talk about investing in general. And anything they wanna know, I'll be happy to share. And then with also if they've got let's say they have a rollover situation of a 401(k) or something like
Mm.
that. They have a past employer and they wanna take it over and roll it into an IRA. Yeah, we can look at what's in it, or we can do that same Q&A type thing and get them started. Yeah, that's no problem with doing anything like that. Sure.
And the best place to get a hold of you if they actually have a portfolio that is that size that they
Yeah.
wanna reach out to you?
Well, all my contact information is in the book, and
Okay,
I'd appreciate it if they read the book before they, because it gives them a lot of answers to a lot of these questions
okay.
and save us both some time, and all my contact information is there. I have a website called theincomecoach.net, and they can also start there.
Okay. I will also put that in the show notes. Sir, thank you very much for coming on. Love what you're doing. I think there's just so much more to be had. We could have probably have a 2-hour conversation on this and still not scratch the surface. But
I've had
uh,
some of those.
yeah, I truly, it's in it. I'm gonna go take a look at your book, and I love reading, so learning something new is always top of mind. But also knowing that there's another aspect of the market out there that I know of that stuff, but not enough. I'd love to be able to
Okay.
learn about it. Definitely will be picking your book up.
Okay, great. Thank you.
Thank you, sir, for coming on, and have a great day.
You too.